It's Friday, October the 20th, and here we are.
Moving through the month of October, it's supposed to be a kind of rainy day today, but it's fall. And
Earnings are starting to trickle in.
Yeah, they are. 6% of the S&P 500 has come in, and that's not a big number, but I think the number was 84% of those are showing positive earnings per share. Yep. So that's working. We've talked during the week on the radio show about the competition that is occurring between bonds and the stock market. And we asked Cousin Andy, would you ever think that we would ask you a question that do you believe there is a competition in the sense of competition between bonds and stocks?
When you have higher yields like what we're seeing both on the short end of treasuries and on the longer end now, as we're starting to see an uninversion occur, when you start to see the 10-year, which yesterday went over 5% for the first time since 2007, when you start to see that happening, you start to see money come out of stocks into bonds for not only safe havens, but just for a good yield.
A return. So you're competing against yield, interest yield versus the growth opportunity. And when you get into that 5% world, that is enough to draw money from the stock market to the bond market.
We have a lot of sophisticated clients that understand risk very well, but I can't remember a time when I've seen more of our really sophisticated clients saying, give me 5.5% any day. I don't want the risk of the stock market with all that's going on right now.
Now, we don't have a crystal ball, but if you ask the question, do you believe that 5% is going to go past into 2025, 26, 27, more than 1 year, what would you say?
Probably not. I think we'll start to see interest rates come down sometime next year, probably later next year. But for now, capturing even if it's a 3-month treasury bill and then have it renew every 3 months is not a bad way to go. And it's been the track that we've been on with a lot of our very safe money.
So it is a phenomena that is occurring right now. It is something we're trying to take advantage of. But for those that, if you were in the stock market, the S&P 500, year to date, earlier in this week, the year to date number for the S&P 500 was up 10%. So we're talking a bucket of 10% versus a bucket of 5%. But let's stop for a minute. Think about all the anxiety that you would have had to gone through, maybe the sleepless nights, the worry, the phone calls, what's happening in my portfolio in a year's time to get the 10%.
And most of that returns come from 7 stocks, and right. We all know what those 7 stocks are. So we don't have a market that's healthy that has a lot of different, not only stocks, but sectors doing well. We really have about 7 stocks carrying the day.
Many of you are asking us the question that's on all our mind, the Middle East situation, the horror that's going on, the brutality of what's going on. Is it going to affect the stock market? And the answer is potentially it could, but if it stays contained as it stands right now, the market is looking through. But if other countries become involved, if the U.S. is involved more than it is right now, then we'll have to have discussion about what to do in the portfolio in terms of protecting it against that. But as it stands right now, the stock market is actually looking through that hard situation that's going on in Israel right now.
Absolutely correct.
So there you have it. Competition is healthy. Having a safe haven at 5% plus is healthy, but looking at good, solid performing stocks is also a good thing to do, and is what we're doing. And we do it each and every week. If you have any questions, please give us a call, because we know it is your money.
And your money matters.
See you next week.